managed to meet and have a chat with each other. Part of working with Kuber is being very sort of collegiate with each other and obviously with our clients, and hopefully you've met some new people and reacquainted yourselves with other people. Martin, thank you again for your presentation. I really appreciate it, and also Sean for your first presentation. We're now going to hear back from Sean on some CGT opportunities, which will be followed by Keelan Doyle from Simvan, who will be talking about his product solution to the CGT potential that Sean's going to discuss. We will be looking to break and finish around about 12 o'clock.
Good morning again. The first session really wants to talk just about pensions, and we have 6 asset-backed managers, of which Martin's 2 of them, and we felt that that's probably where the vast majority of pensions contributions are likely to go. This session is to look purely at capital gains tax and the solutions for capital gains tax, because quite often in this marketplace, when we talk about doing capital gains tax planning for clients, we often look at EISs and deferring tax. And this is, as the slogan goes on this, is to let's mitigate, let's see if we can get rid of it completely. But do it from a no risk point of view. So no risk to the client in the highest risk investment we do. So I'm glad you all had a bit of caffeine in you, and or a bit of a sugar rush, because it's a wee bit of a maths bit this session. So if you hadn't guessed already, I'm the Kuber nerd when it comes to this type of thing, and this type of planning. So go with me on this. So just really to sort of recap about capital gains tax. We've got new capital gains tax rates. So I expect when a lot of the new capital gains tax rates came in, you started looking back in your client bank, because with inside both EIS and CDIS you can go back 3 years. So clients that have paid capital gains in the last couple of tax years will be in a position whereby they would possibly, if they're a higher rate taxpayer, paying a higher rate, and you started to think, oh well, is it worth me going back and doing EIS investments for deferring that, so getting back the 28% rate and deferring it to a year in the future where you're going to pay 20%. That's actually not a bad idea, because if you think about it, you're looking to get a 30% income tax rebate. You'll also get back the 28% tax that you've paid, so it's starting to accumulate quite nicely, and deferring it to a later date to potentially a rate of 20%, which sounds rather sexy. Obviously, some of the new CGT rates don't apply to secondary properties as such, because that's still at 18 and 28% on lower and higher rates respectively. And sorry, I would like to ask this question. Can I just have a show of hands from professional people that are in this market? How many of you used fully your CGT allowance last year? Oh, see, it's one of those things. We talk about it, and we're all often quite amazed about our clients when they haven't used their CGT allowance, but actually we're kind of bad as well. And why is this? Well, for some of the advisors that have been around the industry a bit longer, we have indexation, we have total relief. Now we don't have those reliefs, and we start thinking about actually we have a lot of clients who have accumulated a lot of CGT arrangements. I might stick my hand up and say I've used my CGT allowance, but can I talk my parents into selling some of their shares and using their CGT allowances each year? Can I? No. They're just not interested in it. They like the dividend. They moan when the share price drops, but they don't manage that whole relationship. And we've often got clients in that circumstances as well. So wanted to talk a bit about capital gains tax and look at a particular case study. So I think this might help to explain where I'm coming from on this. So we've got Rob here. So Rob's highest rate taxpayer, so 45% taxpayer. In the last 2 years, he paid 40 grand in income tax and 35k in this year. So total for income tax relief potentially against an EIS or a SEIS EIS investment of 75,000. He was widowed a couple of years ago, so something that hasn't been on his horizon was IHT. Now he's obviously had to deal with his wife's estate. He started to think about some of the impact and also starting to think about what he's going to leave for his kids. Got a big IHT bill. It's got 511,100 shares. Why that weird number? Well, I can't think of why a CGT allowance would be 11,100 and where I might get that number from, but go with it. We originally put 250,000 into shares. So in terms of, if you looked at that, well, 250, so 511,000, take off the 11,100, take off the 250, so we've got a 250,000 pound gain. So in terms of 250,000 pound gain at the highest rate tax, means that he's got a capital gains tax bill or liability of 50,000. Also got an IHT bill of approximately $250,000 or so. So, but if you think about that 50,000, what is that to the client? Well, that 50,000, if he pays the tax, is a loss. You know, that's it, it's gone. And what I started thinking about when I started thinking about capital gains tax was I started doing a bit of planning earlier this year for an IFA, and this was using on entrepreneur relief. Because when we look at somebody who's selling a business and we look at the 10% capital gains tax rate, I don't think many people would consider using an EIS to defer that tax, because let's say, similar numbers, let's say 511,100 is what I've sold my business for, so take out my CGT allowance, I've got 500,000. 500,000 at 10% rate is 50,000. So if you said to that type of client, oh, instead of paying 50,000, give me all that 500,000 and we defer that tax to 5 years down the line, but you get a bit of income tax relief now, I think most people will say, no, I'm not really interested. However, if we could say a number, say around about 100,000, and say, give us 100,000, and instead of paying that 50,000, we could cover your tax bill completely, but you've still got 400,000 to play with, that's a different conversation completely. And this is where I came to for a similar idea around the shares. So, Rob's option. He could pay the 50 grand tax, but we said that's a loss. He could defer it through EIS, or what I'm looking at here is completely wipe it out under SEIS EIS. So, what are the three options, or what are the three main benefits under SEIS EIS? Is a 50% income tax relief, a 50% reduction in capital gains, and also a return that is free of income and capital gains tax. Okay, there are some restrictions with inside EISs of £1 million investments. Inside SEIS EISs, that's down to 100,000. But again, you can go back to the previous year and get the previous year's allowance if you haven't used it. So you could invest up to 200,000, and you've also got an income tax rebate against, again, the last 2 years. So, what can we do for Rob? So instead of Rob losing 50,000, he can invest 100,000 into a SEIS EIS. So SEIS EIS is early stage EIS investments with inside companies. But effectively, because we're doing this instead of paying the £50,000 bill, it makes it an effective cost of only £50,000. So we haven't paid the £50,000 old capital gains tax bill. However, our new CGT position is, well, do you remember we said we had £250,000 gain originally? So instead of having a £250,000 gain, we have 150,000, which is the 250 less the 100 that you're doing into seed. Gosh, you're wishing you had another coffee now in front of you. Then at standard rate of 20%, so he's got 30,000. Plus we've got to add in the remaining 100,000 at 20%, which is 10,000. Sorry, that's a typo. Therefore, we've got a new total tax bill of 40,000 in total. So we've gone from 50,000 down to 40,000. However, we have an income tax rebate from the seed investment of 50%. Client invested 100, that's 50,000 back. So that's effectively, you had 100,000 invested, only cost you 50,000, and it covered the tax bill, and it left 10,000 over. 10,000 over, the way I look at that, 10,000 over, 5,000 to us in costs, sorry, 5,000 to the client, 5,000 to us and you in costs and advisor fees. So even still, the client is £5,000 up. So the highest risk investment we do in this marketplace to the client, it's all covered. 100,000 goes in, it's all covered. I was thinking, well, let's think about what's the worst case scenario. Well, the worst case scenario is all the investments go down to zero. So if they all went down to zero, he's got his 100,000 that's gone in, he's had £50 worth of relief, he gets loss relief on the remaining 50, he's a 45% taxpayer, 45% income tax relief or loss relief on 50,000 is 22,500. Yeah? If you think about, well actually, is that all? No, he also got 5,000 extra anyway. So he's up to 27,500. That's in the worst case scenario. So we didn't pay his tax, we covered the tax relief, so it's an investment for nothing, so no risk. Minimum return, 27,500. You know, it goes to 50%, then he gets 50,000 back, plus his 5,000, so 55,000. If it wipes his nose and gives the money back, 100%, 100,000 and 5,000. It's one of those things that almost seems like a no-brainer. Okay? I used to be a compliance officer, so I always have this in the back of my mind, that although this is a no-risk investment, in the highest risk investment we do, I'd still need a client to either have a risk rationale that is suitable for that high risk, or a percentage of their total estate that can take a higher risk rationale against the remaining part of the portfolio. Because if not, if they're not in that position, then I think that, let's say if they did return that 22,000 or 27,500, they'd be saying to you, I gave you 100,000. When you say, yeah, but you gave us 100,000, you didn't have to pay 50,000, and it paid your tax. You know, you're up, and they go, I'm not sure, that seems outside of my risk rationale. So from a compliance point of view, you want to make yourself safe. This is a phenomenally good way of dealing with capital gains tax. What would you do in that scenario when it matured? You'd probably say, well, unlike an EIS where you're looking to place it in again, you'd probably say, well, if I've got income tax, yeah, I'll do an EIS again, or a CDEIS for the income tax relief. If not, it's IHT free at that point, I'll drop it across into BPR. Either way, the vast majority of our managers pay us another rebate. So you get another extra return at an advice point for that type of client. Yeah? So stunned faces. Wish I hadn't come out for a maths test. Okay? It's a really, really clever way of dealing with it. Where it falls down is often clients don't have enough income tax, they haven't paid enough income tax to do a substantial investment on a 50% rate. We had a scenario like that the other week. I was chatting with the IFA and said, "Oh, did this client have any bonds, onshore or offshore, with providers that have left the market?" And you went, "Oh, yeah, actually." I said, "Well, keep in mind that if you trigger a chargeable event on those, you know, because you got upset with them because you can't get any servicing information, you can't do anything different to them, then we can yank those out. The chargeable event is a taxable position against his income tax position. So that might booster, so we might take just certain segments of the bond, booster the income rate up to a high enough level to make sure that we use all of his income tax relief on the SEIS side of things." Okay? Manipulations of chargeable events on bonds I think are going to be available probably for the next 18 months before they change the rules on chargeable events on bonds. So don't forget, not just doing it as whole segments, there is a potential to boost income tax relief if you need to by going across the segments. Hopefully if you apply for a withdrawal across the segments, the insurance company should phone you up and say, you insane? But don't forget, if you can trigger a tax charge which you're getting a relief on against an EIS or CDIS straight away, as long as you leave that bond for at least 18 months, so outside of both policy and tax year, when you next come to surrender, that chargeable event will be used within the side calculation. So you could have a surrender point at the future where the client could be a 45% taxpayer and pay absolutely no tax on it whatsoever. This has really come to the fore. I used to work for AXA, I used to run the international tax and trust people. And I was thinking AXA, in the last sort of month or so, has been sold out. And I was thinking the AXA International Bond through Isle of Man used to have this great facility that used to allow you to wrap around a discounted gift trust at a later date. It's absolutely fantastic. It's almost like future-proofing your bond. That's now been sold to a few guys down in Dublin. And I'm not sure that they're going to say, okay, yeah, we bought this book of business. You now want to do what? Okay, so that's going to cost me £1,200 to £2,000 to get it underwritten. Okay, we're sure we're going to be happy to pay that. Oh, it's also going to cost us how much? What, 20 to 60 grand to make sure that our trusts are up to date all the time? I can't see that happening from a personal point of view. For those of you who might remember Aegon, they had a Luxembourg outfit for a while, did a few flexible reversionary trust schemes out there. Trying to get information out of them, the last time I tried was 4.5 months to get a valuation. So, and I start thinking, well actually, contracts that are leaving the market, how useful are they? Well actually, they can be very useful for helping us making sure we make the use of capital gains tax. Okay. So, what about the rest of the funds? Well, the rest of the funds, so we had, we realised about 500,000. So we would put 100,000 into CDIS, we could put the remaining 400,000 into business property relief. Oh, by the way, you could do that all through one application with us. So you could have, I don't know, 7 CDIS investments, you could have 5 BPR investments for that client, all on one platform, one application, and make your life really simple. 2 years down the line, all the funds are outside of the estate for IHT. So, well, 2 years after qualifying the investments. So you'd say, well, okay, well, what's that saving? Well, it's saved Rob about just shy of £250,000 in terms of inheritance tax. We've also covered his capital gains tax, so we saved him an additional amount of money, because we know that worst case scenario he's getting back 27,500. So really, really, really sexy in terms of investments. You've helped a client that had major issues because hadn't really managed his capital gains tax and hadn't really thought about his IHT. You've ticked a hell of a lot of boxes in one transaction, or numerous transactions that you've done all through one application for. These are all managers that we've done due diligence on. These are all managers that we have strong relationships with and we update our due diligence on an ongoing basis. How good does this sound? Diversified investments that covers your capital gains, income tax, IHT. That sounds pretty hot to me. So, what I want to do is pass you over to Keelan. The particular reason I wanted Keelan to come along today, Keelan's works for Simban. Simban has one of the seed EIS investments on our platform, and really wanted him to get you to have a good feeling for how he invests, or how the company invests their funds, and how they're put together. Because although we often talk about seed EIS being the absolute highest risk investments, there are ways and means to mitigate that risk over the time period. So I just want to hand you over to Keelan. Thank you.